Alrighty, good morning everyone. Tim Hart here. I'm the Director of Private Mortgages Australia. Thanks for joining us on this webinar. We're going to talk a little bit about private lending in 2018, what we sort of see in the lending environment and sort of how private lending can, I suppose, play an active part in that role. And then I'll talk a little bit about our process and sort of how private lending works and some of the things that we're doing in the marketplace that will no doubt be able to help some of your clients. So guys, let's get started. We do have a couple of people still trickling in, yeah, we are recording this, and it will be on our website in the resources section shortly after this. So let's jump into it. Private lending in 2018, and where we see the current lending environment. Basically, we see the banks lending a lot less, especially around development. They've got some really strict guidelines on what they and who they will lend to with development. And this has been spurred on a lot of regulation that's coming in from APRA in particular, but also you have ASIC there as well. So the banks are quite cautious, as they always are. And we're starting to see Sydney and Melbourne property prices starting to cool. And no doubt the banks have seen this coming. And so that's why we see them really starting to pull out of the marketplace and really picking and choosing who they'll lend to, as opposed to just sort of anyone that kind of fits the mold. The other thing we see as well, especially for 2018, is definitely a pressure on interest rates to increase. Whether or not they will, I don't know. Maybe a little bit towards the end of the year, but definitely it seems that they will be increasing unless we see something else happen in the marketplace. And where I suppose where this puts us and our plan for 2018 is very much to increase development funding, just because there's the demand there that the banks just simply aren't looking after. So we see a lot of that, and we'll go through an example in a moment as well. We also just recently, you may have heard that we've increased our LVRs. We'll actually do up to an 80% loan to value ratio, which for private lending is almost unheard of. And we do it for selected postcodes. So it's only on residential security properties that we'll do it. And it's where we can get a favorable report from an analytics firm that looks at the different markets and different suburbs and where they're going to be headed. So that allows us, if we can see a positive growth in a particular suburb, then allows us to go up to the 80% LVRs. The other big push that we're doing is educating referrers and really educating the marketplace on private lending. And it's a massive alternative that especially if you're a mortgage broker in 2018, then you need to know about private lending. Unless you're only dealing with mum and dads who buy their own home, private lending is something you need to know about, and it's going to be able to help a lot of your clients. When the banks just simply can't help them. So one of the things we've done, we've just put together a lot of training videos. So you can see this is our website. Under our resources section, there's training videos. So it might be just a little 1-minute video on how we qualify a transaction, or how does development finance works, or what's the difference between a coded or non-coded loan. So if private lending is new to you, then here you can find the answer to a couple of your questions. So that's all on there on the resources page. We've also got case studies on there. This video will be uploaded in the resources section as well. So there's plenty there, because ultimately we get around 95% of our business from referrers. So we want to make sure that we're helping them help their clients as best they can, and a lot of the time looking to see if a private loan is going to help them in the situation they're in. So with that in mind, let's look at what private lending is and the types of products that we actually look at. Now, as we're going through, I'm probably going to talk for around about half an hour or so. There is a little questions box. So in the panel there, if you're listening to us live, please ask any questions. We'll get those answered. If you have a particular scenario that you want to run past us, we'll have the details at the end of Shanta, who's our Senior Relationship Manager, that you can contact to actually run a scenario past us. So if you have any general questions, please post them on there. So these are our 3 lending products. So we do first mortgages, like every lender in the marketplace, but we also do second mortgages. So if a client needs a bit of a top up, or maybe they've already got quite a good cheap first mortgage in place, and they just want a little bit of extra funds for a short period of time. So you'll see first mortgages anything from 1 to 2.5% PCM, so that's per calendar month. So most of our loans, our average is probably around 6 months, and our shortest term is 2 months. Anything from 100,000 is the minimum up to about $2 million. Now we can look at loans that are above $2 million, but they're not approved in-house. So we just let you know that up front. But sometimes we have other external funders that can contribute funds into a deal for us as well. First mortgages, so second mortgages, 1.5 to 3.5% per month and up to $1 million. The third one we've got here is a caveat second mortgage, where we literally don't have time to register our second mortgage. So this is where a client needs to settle a property, maybe within a couple of days, and we can do that and just register the mortgage at a later stage, and that's amounts anything up to about $500,000 for those. So the other thing we get asked a lot is, well, how much will you lend my client? And it really depends on where the property is located. So we have category 1, 2, 3, and 4. That is based on the Genworth Financial postcode categories. So if you don't know Genworth Financial, they're one of the mortgage insurers in Australia, and they basically put every property into a different category. So category 1 is most properties. So anything that's within 40 to 50 Ks of a major CBD, like a Melbourne, Sydney, Brisbane, is going to be category 1. Category 2 is more your major regional towns. Category 3, a little bit further out, maybe your smaller towns. And category 4 is affectionately known as whoop whoop. Okay, so a property that's literally in the middle of nowhere. It might be rural, might be farming, those sort of things, where category 3 and 4 you find, especially in this environment, a lot of banks aren't lending. They're just saying, no, we'll only lend on prime security, and they won't even look at it. They won't even look at a reduced LVR. They won't do it. So that's sometimes where we can come in and help. But you can see, obviously, a property that's further out, that's in the middle of nowhere, we might still go to, say, 60% on something residential. Whereas if we had a property that was, in near Melbourne, then it might be more like 75. Now, on the other side, we've got there is the maximum. So private lending is all about flexibility and discretion. Okay, we're not like a bank that, here's the box and you have to fit in it, otherwise it doesn't work. It's all about coming up with a solution that's going to work for the client, but also for us as well, to be a win-win outcome. So we do have discretion to increase the LVRs to 80% for residential, like we spoke about before. We've got commercial, we can do up to 75, even industrial we can do up to 70, provided it makes commercial sense for us to do so. The other thing we get asked a lot is, what are the fees and charges? And this is where we really push in the marketplace, is to not just look at the interest rate, because especially when you're looking at private lending, and you're asking someone to come up with a loan very, very quickly, there's a lot of cost, and it's a timely exercise to get it done quickly. So there's other fees and charges involved. And so it's really important to make sure you look at the total cost of the loan, not just how much the interest is. So for us, the other cost associated with our loans is we have an approval fee, so sometimes called like an establishment fee, like the banks call it. And now this will depend on how much they're borrowing as to how much this will be. So anything up to $500,000 is 3.5% of the loan amount, and then it sort of taps out at 2.75% when we get all the way up to $2 million loan. Now, built into that approval fee is a referral fee. So it's if the client comes to us, we charge them 3.5%. Included in that is 1% that we pay to our referrer. Now, you'll see there that our referral fees are channel agnostic. So even if a client comes to us directly, they still get charged the same approval fee. Okay, they're not going to get it cheaper if they come to us directly. So that means that there's no incentive, I guess, for a client to come to us directly. That either way, that we're going to be paying a referral fee out to our referrer. What we also charge is an assessment fee. So when a loan comes in, we'll charge an assessment fee of between $550 to $770. Depending on the complexity of the transaction. And basically this just covers our cost to do title searches and bankruptcy checks and credit checks and some desktop valuations as well. So that's just really to cover our cost. Any legal fees are always done at cost, and any valuations, if they're required, are also done at cost. Okay, so we have no profit margin on anything that we do. The only place I suppose we make some fees is the approval fee. So let's look at now how we actually work with our referrers. So a couple of ways. We've got the referrer service fee. So obviously you'll get the fee from the approval fee, but then we've got the service fee in there as well. Or you can mandate your client directly. So this is where you might have quite a complex, maybe it's a development deal that's going to take a lot of your time, that you might want to add a service fee of $1,000 or $2,000 in. So we can put that into our indicative letter of offer for you. The other thing that we do that I don't know of any other lender in the marketplace that does this is we pay subsequent referral fees are paid even if the client comes to us directly. So if you refer, John Smith to us, and he has a loan with us, he pays it back, and we had a great experience. He then comes back and says, hey, we'd like to borrow money again, but he comes directly. We will still pay the referral fee to you. So which is a bit of fun for us, because it's nice to call up one of our referrers and say, hey, can you send us an invoice for $2,000 for a deal that they did nothing on? They didn't have to do any work on, because we see it as your client, and we want to make sure that we're thanking you for bringing them to us as well. So the only time that we wouldn't pay a subsequent referral fee for John Smith is if he then employed another referrer who brought it to us directly. So obviously we're only going to pay out one referral fee, but it's just to stop that client coming to us directly. The other way we reward our referrers is the referrer rewards program. So as you hit key milestones with us, we basically send you gift cards. It's just another way to say thanks for sending us business through. So once you hit $500,000 of loan volume, we'll send you a $250 gift card, and that's of your choice. So we'll just ask you, it might be Dan Murphy's, it might be Maya, whatever you want. And just the other thing that's worth noting is these referrer rewards are cumulative. So let's say the first loan you did with PMA is a $2 million loan. You'd get the $1,000 gift card plus the $500 plus the $250. Okay, so it can add up quite quickly, it's always a nice little bonus that you can get in addition to the other fees that you make. All right, let's have a quick look now at our settlement process, because with private lending, it really is all about speed. Where the banks might be taking 4 to 6 to 8 weeks. Most of the time we can turn around a loan within 1 to 2 weeks, and the shortest sort of time frame we do is around 3 days. Okay, so it's really, really quick funding that we do. The way we do that is that the start of the process is that the client can either fill in an application form, or we've got a quick app. Now the quick app is literally, it's 2 pages, and the client doesn't even need to sign it. It's just the real high level details of the transaction that we can do our initial assessment and come back with an indicative letter of offer. In that offer, we'll have the indicative rate and the assessment fee that needs to be paid. We'll then complete our due diligence and then issue the formal letter of offer. As soon as the formal letter of offer is signed, our solicitor normally pairs the paperwork within 24 hours, and then we can then send that to the client and proceed to settlement shortly thereafter. So it's designed to be a very quick and streamlined process once we get the application in. Now, one of the big things that we look at, is what's the process that we go through when we have a new loan that comes in. So I want to tell you how we actually qualify our deals, and we call it the first filter. So to make sure that the deal is actually going to be able to proceed. So the very first one is non-coded. Is the loan non-coded? So this is whether or not the loan falls under the Consumer Credit Protection Act. So Private Mortgages Australia, we can only do non-coded loans. So that's only for business purposes that we can do it. So the way we do that is if the borrower of the funds is a corporate borrower, so it's like a company that's borrowing the funds, it's automatically deemed to be a non-coded loan. We don't even need to look at the purpose. It's only when it's an individual borrower, that's where we need to look at what the funds are used for. So it's for domestic purpose, like they want to buy their own home or they want to go on their own holiday or buy a car, then we can't do it. Okay, we can only do it when it's for a business purpose, and more than 50% of the funds are for a business purpose. So great, if they want to go and buy a boat or whatever for $20,000, that's fine, provided they're borrowing more than $20,000 more for a business purpose. Now that might be to buy in stock for a business, buy into a franchise, pay out a business partner, pay out an OTO debt, might be a developer finishing up a project, whatever it is, provided it's for a business purpose, it's then a non-coded loan. Failing that, we also look at the types of security. So if the security property is a commercial property, the loan is deemed to be commercial in nature and therefore a non-coded loan. Residential, same sort of thing applies. We need to look at the purpose of the loan and make sure that more than 50% of the funds have been applied for a business purpose. Okay, so that does knock off quite a few loans sometimes, where they can't borrow it for a genuine business purpose. The next one is 1% per month. So we want to make sure that the client is prepared to pay at least 1% per month as an interest rate, because that's the cheapest interest rate that we'll do. Because essentially you're borrowing money from private individuals, so the cheapest rate is going to be 12% that they'll accept for the funding. So we want to make sure that they're not expecting to get bank funding at 5 or 6% or something like that, that this definitely is short-term funding and that the rates are much higher. The next one we look at is the postcode and LVR. So we'll go back to that table I showed you before with the 4 different postcode categories, and just make sure that where the security property is and the amount of money or the LVR that the applicant is looking for makes sense. So they're not trying to borrow 80% in a category 4 location. The next thing we look at is the referrer service fee or mandate. So we want to make sure that before we send the offer to the client, that it's got, if there is a service fee, that it's noted in that offer. So it's all done upfront. The next and probably the most important one is the exit strategy. So we want to make sure, if the client is going to have this loan for say 4 months, how are they going to repay that loan? Okay, we want to make sure we're setting the client up for success, that we've got a genuine exit strategy there. Now it might be the sale of an asset or the sale of the property. It could be a refinance to another party. It could be they have some income coming in from the business, but we just need to get some evidence of that. But the biggest thing we've got there in brackets is serviceability is not required. And this is what has won us a lot of business, and I can see this continuing a lot in 2018 as well, is because our loans are designed to be their short-term loans. So it might be someone borrows some money for 6 months. We actually prepay the payments for them. So we capitalize the payments in there. Therefore, there is no payments. Therefore, we don't need to worry about serviceability. It's more of an asset lend. So this is really, really good for clients that, one, can't prove serviceability, or someone that doesn't want to have to make payments along the way. It's just, I need the money to finish off this project, and then I'm going to get all this money back, and that's when I'll pay you back in one lump sum, as opposed to needing to continuously make payments along the way. So once we've got that sorted, the next question we want to know is, why can't the client get bank finance? Very, very important question, because if the client can get bank funding, don't use us. It's not going to be our slogan, but we're never going to be as cheap as a bank. So it's always, go and get bank funding if the client can. We're there if they can't get bank funding, or if the bank can't deliver in time. So they need to settle within 1 to 2 weeks. They can't wait for the bank to take 4 to 6 to 8 weeks, or perhaps the uncertainty that the bank might say no, and they need to get a deal settled. So that's really important that we make sure up front that there's a reason why the client needs the private funding. And the last one is quite simply, when does the client need to settle? We want to make sure that we're working together with the client to get them the funding when they need it, not just when the loan is ready, which is kind of the bank's approach of, the loan will be ready once it's gone through the bank's processes. Whereas, if we know upfront, great, the client needs to settle by this date, then we can work to make sure we can settle on that date, so that the client can get the property or settle whatever they need to do. So let's look at a bit of a case study, and I can show you how we apply our filter to it, but also why it made sense to the client to take the loan in the first place. So this is the scenario. The clients had a development site in Altona North in Melbourne for a 3 townhouse development. Those of you who don't know Melbourne, Altona North is very, very close to the city. We're talking within sort of 5 Ks, down near Williamstown. Great spot. So definitely a Category 1 location. Basically, they had run out of money. So they were trying to sort of self-fund the development, and they were basically 90% of the way there and ran out of money, and the builder didn't want to finish the job until he got paid. Fair enough. The issue was that they couldn't get bank funding. There was no bank finance for sale on the two townhouses. So it just meant that they couldn't get it. So it meant that they had two pre-sales there, but there was no bank funding available for them. So the numbers on it, the valuation, so we got a valuation done which came in at 1.95 million once the three townhouses has been completed. They already had a first mortgage of 520. They had a building contract of $650,000, and they had self-funded $250,000 of it. So there was a shortfall of $400,000 to complete the development. Now, they actually owed the builder at the time $330,000 of work that had already been completed, which is why he had stopped work. And they only need the money literally for 2 months to finish off the build. They can then trigger the pre-sale contracts, and we would get paid back. So what we did, we applied the first filter. So is the loan non-coded? Yes, it's a company that was the borrower. 1% per month, yes, the client was happy to pay 1.9% because it was a second mortgage facility. The postcode was category 1 and the LVR was less than 65, so that married up. The referral fee was $2,871 that got paid to our referrer, and the exit strategy was the sale of the units. The reason they couldn't get bank finance was endless, but they were self-employed, no financials, no experience. So this is their first development, which a lot of banks will not lend unless you've done a development before, and also the time frame. Most banks they don't like to get involved in a project that's half finished. They're happy to get involved right at the start before anything happens, and they're happy to refinance it once it's all finished. But there's this zone in the middle where no one likes incomplete security because obviously it can present issues. And the client needed to settle as soon as possible. They had an outstanding invoice of $330,000 to the builder. So really time was really of the essence to get this finished. So the solution was we provided a $435,000 second mortgage, which included the 2 months worth of payments. The interest rate was 1.9% per month. We gave them 2 months plus the extensions. So if they needed a bit more time, they could just make a 1 month's payment to extend the facility. And the exit strategy was the sale of the townhouses. Now, the next thing I want to cover, just spoke about briefly before, was that interest rates are irrelevant. And I say that I'm just, almost jokingly, but they're irrelevant compared to analysing the total cost of the loan, okay? Because the total cost of the loan includes the interest cost. What we see in the marketplace, especially with private lending, is a client, if it's their first time, they're usually used to a bank and they think all mortgages should be 5% or 6%. They see an interest rate that might be 1.9% per month, and they look at that and annualized and say, well, that's over 20% per annum. But it's kind of looking at, okay, well, how long do you need the funds for? But also, what's the actual cost? How much is this costing you to get this done? So for this one in particular, the interest was $16,530 for the 2 months. The approval fee was just over $15,000, and the legal fees was $2,735. So all up, to get this facility, and including the payments for the 2 months, was going to cost the client $34,471. Now that is a figure that you can kind of make sense with, and you can see that the interest cost was actually less than half of the actual cost of the facility. So this is why it's so important to look at the total cost when trying to work out if a private loan works for the client. So this is sort of the calculations that we encourage our referrers and our borrowers to do, is to look at how much is that in relation to how much money they're going to make from the deal. So for this one, the gross realization value was 1.95. They had purchased the land for $650, 35 grand for stamp duty. The build cost was $650. We estimated they had some other costs of real estate agent fees, council contributions, and holding costs of around about $115,000. So all up, their gross profit they were going to make from doing this deal was $500,000. Now, so the question that we then ask is, does it make business sense to give away 7% of your profit, being the $34,000, to get the deal done? Because there's no other way that they can finish the transaction without the money. And then you can actually start to look at it and say, well, actually, it was quite cheap for them. Okay, because if they had to get a private lender, like an equity partner, to come in and put the $435,000 in, they're probably going to want a lot more than 7% of the profits. They're probably going to want half the profit or something like that. So you can see it really does make business sense for them to get this funding in place. So that's how we sort of we encourage people to analyze transactions. But the other thing I want to show you is some of the other things that we specialize in. So by and large, it's urgent funding. So a client that needs funding really, really quickly. The bank's pulled out on them, or something's gone wrong. They might be under a deed of rescission, or the bank's just simply saying no and they need the funding. The other big one, development funding, which we see is really starting to pick up steam a lot at the moment. Asset lending, where we will lend against the asset as opposed to looking at the serviceability of the client. Paying out ATO debts, something a lot of other banks will not do. And a lot of times they won't lend to a client who has an outstanding ATO debt. So we've done loans before where we will come in, pay out an outstanding ATO debt for the client, so they've got a clear ATO portal. They can then go and get refinanced with that traditional lender once they can show that clear portal. The other thing we've done is refinancing existing caveat loans. So some other caveat lenders in the marketplace that have extremely high default interest rates. We saw one the other day that was 15% a month in default. And so where before we can come in and refinance that person out to a much, much cheaper facility that might only be a couple of percent a month, and give them a bit of breathing space to then go and refinance or affect their exit strategy. Something else we're seeing is valuation, not contract, where we're happy to lend on the higher of valuation or contract price. Okay, because we're investors, we're property investors as well. We live in the real world where you can buy a property under market value. So we're happy to lend on that valuation price as well. So we've lent. We did a loan the other day. We lent 115% of what they bought the property for. Okay, but that was only 70% of what the valuation came in at, and so that can really help our clients, whereas banks will always take the lower of valuation or contract. Another thing we see is people paying out business partners, so they want to buy them out. Maybe one's retiring and they just need to cash them out. We can provide the funding for that. Another big one is urgent business opportunities. So someone can buy a property really cheap, maybe from a receiver, or they can buy stock from a competitor, but they need the funding really quickly to do it. The last one I want to comment on is credit impaired. Okay, because we're not like a traditional bank and we're more focused on the asset, we don't so much care about the credit of the client. Okay, so if someone's got a lot of defaults or they've previously been bankrupt, that's not an issue for us unless the client exit strategy is to refinance. Okay, we might look at it a little bit more carefully, because we want to make sure that we're setting the client up for success, that they can get refinanced even with whatever credit issues they might have. Okay, just a couple of things I want to cover here is a bit of your borrower beware. And this is especially for those of you who are maybe new to the private lending space. It's just some of the other things that private lenders do in the marketplace. And none of these things are illegal, but for us, we see them almost as dirty loans. And Private Mortgages Australia, we're all about doing clean loans that are transparent and that provide win-win outcomes for both parties. So some of the things we see is lenders quoting from rates. So they might say we do lending from 1%, but there's no upper edge on how much that interest rate might be. So we saw one the other day that was they were saying rates from 1%, and then when the offer came back, it was a lot of the time was coming back at 4%, 5%, and 6% per month. That at least with Private Mortgages Australia, it's a first mortgage, it's going to be between 1% and 2.5% per month. It's not suddenly going to come back way above that. Another big one we see is big upfront fees before the final offer. I saw one the other day, it was $18,000 that the client had to pay upfront as a commitment fee, I think they called it. And if the loan didn't proceed for whatever reason, the client pulled out, the lender pulled out, then they lost that $18,000. And so just be wary of those sort of fees before you actually get to see the final offer. Another one we see is lenders saying they can do 24-hour loans, so they can sell a loan within 24 hours. Very, very hard to do. I mean, even if you just look at getting documentation in place from a solicitor, to get a solicitor to do paperwork in 24 hours is pretty phenomenal, let alone doing an application from start to finish and drawdown and giving them the money. So a lot of the time they use this tactic as 24 hours to get the client into the system, and then lo and behold, it takes another 24 hours and another 24 hours. And before long, they'll usually ask the client to sign an offer that has a charging clause in there. So just be wary of that. I don't know of many lenders in the marketplace that can do 24-hour loans, and certainly at Private Mortgages Australia, we cannot do 24-hour loans. The quickest sort of time frame that we do is 3 days, and that's a very reasonable time frame to be able to turn around everything properly. The other thing we see is very expensive valuations for forced sale. So two things there. One, the lender is sometimes making a profit on the valuation, so charging more than the valuer is charging them. But also the purpose of the valuation is for forced sale. So they're basically telling the valuer, give me a really, really low value here. And so all of a sudden, where you thought you might be getting a 70% LVR, because they've valued the property, 10 or 20% below what it's actually worth, that 70% LVR is suddenly more like a realistic 50% LVR. So it just means the client might not be able to get all the funding that they need, or it's then an excuse for that lender to then cancel the loan and perhaps keep their $18,000 upfront fee. The last thing we see is cancellation fees. So where they might have a charging clause in their indicative letter of offer that if the loan doesn't proceed for whatever reason, then you still have to pay a cancellation fee. It might be 2% of the loan amount, or $10,000 or $20,000. And what they will do, they will caveat the property and basically hold the property to ransom until they get paid out their fees. So just be very, very careful of cancellation fees and charging clauses. So just to finish up here, I just want to, suppose, go through the PMA way, and I suppose how we try and basically do the opposite of what these other lenders are doing. So we have a low upfront assessment fee, so that'll be the $550 to $770, and that's all the client needs to pay until they've got their formal letter of offer. The only other things that the other expenses might be a valuation if it's required, and that'll be done at cost. But it's also done at a reasonable value. So we're getting it done for market value purposes or for mortgagee purposes, not for forced sale. The other thing, we have no charging clauses in our indicative letter of offer and no cancellation fees in our indicative letter of offer. Okay, so there's no, until the client literally accepts the formal letter of offer, there's no other charging clauses. There's nothing else that they need to pay. Valuations, as I said, done at cost. Legal fees are also done at cost. We have capped interest rate ranges, so you always know where the interest rate's going to come in. We also rebate any unused interest on extension payments. So if a client makes an extension payment for a month and then they settle the loan 1 week later, we'll rebate the 3 weeks worth of interest that they paid for that they didn't use. Okay, just a fair thing to do. The other thing we have is custom built software for faster processing time. So we've spent a lot of money producing software that allows us to very, very quickly take transactions in and process them. Okay, so this is how we can actually process a deal from start to finish within 3 days, is by having this custom software that we've spent a lot of money on. The other thing we have is a very high level of repeat customers who come back to us for another loan and another loan. And the reason that is because they've had a win-win approach to lending from us. Okay, it's been a good outcome, that it's been a win-win loan for both parties. So if we compare that to some other lenders in the marketplace, they've probably never had a repeat client because they've had a horrible experience with that client because of all the sort of things, the fees and charges and so forth. So PMA, we're all about a win-win approach to lending, and we really look forward to working with you and your clients. So guys, that's it from us. If you do have any questions, please contact Shanta Loba. She's our senior relationship manager, and she's more than happy to help out and give you a bit of an idea of what we can and can't do on deals. but at least now, hopefully, you can see how we'll process a private loan in the marketplace. So, guys, I'll just quickly check to see if we have. Is there any questions? We've got a couple of questions here. Now, someone says, if the referral fee is taken off the establishment fee if a mandate is signed. So, David, the mandate, if you mandate, it's done separately. So, the approval fee might be 2.75%, of which you would get 0.75. If you also have a mandate for 2%, then you get 2% plus your 0.75. So, okay, so it's in addition to the amount you get from the approval fee. Guys, yes, we've had a few people asking for a copy of the presentation. Yes, we'll send that through. That'll be up on the resources tab. Do clients have to be permanent residents, or can they be overseas investors? We can do stuff with overseas investors. However, they will need to have an Australian company to do it here. So there's a few ways, a few things we can do there depending on the transaction. But yeah, please give Shanta a call in relation to that, because it's really done on a case-by-case basis. Guys, I think that's it. Yeah, that's it. That's all the questions. Guys, thanks for attending. We'll send this video out to you shortly, and look forward to hearing from you soon. Thanks.